congratulations everyone on another year of independent India. And I'll try and make sure that the time you've taken out for this session just before your weekend is worth every minute. Okay, we are going to talk a little bit about AI and its applicability, but more importantly, I wanted to highlight the workings of AI under the hood, because I've seen a lot of people create a lot of buzz about it, but very few people actually convey what it can do and what it can't, and how exactly it goes about accomplishing some of the wonderful results that we see with AI. So hopefully by the end of this session, you would have a better appreciation of certain nuances of AI. Okay, as I said, there's obviously been a whole lot of hype around this topic globally, but also in India. Very colorful depictions of what AI is and how does it apply to financial markets. Of course, we've seen the likes of cyborgs shooting down stocks with laser eyes. We've seen journalists getting excited and talking about quant funds outperforming benchmark with a few months of outperformance. All kinds of vivid imagery, right? And while all that's great, I think very few people, whether in the media or in the academic world or in the financial world, really talk about how does it all work and how do you put it together. So let's start from the basics, right? What is artificial intelligence? And when we hear the term artificial intelligence, machine learning, and deep learning, how do we differentiate between the three? So artificial intelligence, put simply, is human-like intelligence which has been created using technology, right? It's the basic difference between normal kind of computing, right, which has been around for several decades. We know that computers, supercomputers have been around for decades, and they are able to do massive amount of calculations in a second. So where is artificial intelligence difference? Well, one way to look at it, and something that I find a very easy way to explain, is traditionally computers have been very good at doing stuff that human beings find hard to do, right? Big computations, large number of calculations, processing data, which is like going into not just terabytes, but further down, right? What computer is not so great at is what we as human beings do very intuitively. So think about this, right? If you were given a choice between looking at a face, looking at a person, and judging whether that person is happy or unhappy, or recognizing the sound of a person and being able to identify whose sound that was, my guess is most of us would feel it very comfortable to be able to do that job, right? Compared to, let's say, processing 1 million instructions in a second. Computers do that instruction processing very easily, but if you were to ask a computer in the traditional sense to try and recognize that voice or face or emotion, they would find it extremely hard. So computer finds that the tasks that we find easy tough, and the tough tasks for us are very easy for the computer. AI is mostly about helping computers scale up and start to do what we already do very well. But then they scale up and do it better than us, right? So whether it's some of the smartness you see today in Siri or Alexa, or much more sophisticated technologies at work, that's all AI, right? AI is all about, is the machine able to make independent decisions without the need for explicit instructions coming from a programmer? That's really what AI is. How is it different than machine learning? Machine learning is basically a subset of AI. It's not something completely distinct from AI. It's one part of AI which allows the machines to automatically learn and improve. As the name suggests, the machine learns on its own. It learns from its mistakes. It learns from its experiences, the very same way a young human being would learn through their lives and grow with their experience, right? Without explicitly being programmed. So that's the part of AI which is called machine learning. Finally, deep learning. That's another term you'd hear often, right? Deep learning, again, is not something which is completely distinct from AI or machine learning. In fact, it's a narrower subset of machine learning, where the learning method, out of the possible maybe dozens of learning methods, it deploys a very specific learning method which gets inspired from the way human beings learn, which is through our own neural networks, right? As you understand, we have a brain, we have a spinal cord, we have a set of nerves and neurons. And when the machine mimics that system to learn the experiences and to improve, that subset of machine learning is called deep learning. So in summary, artificial intelligence is the general intelligence concept. Machine learning is a subset of artificial intelligence. Of the various kinds of machine learning that's possible, deep learning is one which uses neural network technology to learn. Okay. Let's next talk a little bit about AI in terms of the forms of AI. Broadly, there are three forms of AI that you would see in the literature. The narrow form, the general intelligence form, and then the super intelligence form. The narrow form is what has been, I would say, mostly achieved over the last several decades. One very, I would say, typical example of that could go as back as '96. Some of you guys might remember IBM developed a machine, right, called Deep Blue that was able to beat Gary Kasparov game after game. I think the machine won 4 out of 5 games in chess, right? Gary Kasparov was no common chess player, as we all know that, right? Weak AI is about developing intelligence which can meet or exceed human beings' intelligence or capability, but in a very narrow sense, in a particular area of expertise, right? And that is where narrow intelligence is somewhat limited, right? You cannot expect narrow intelligence to behave like a human person. Other than in its own narrow area of specialization, it's going to never be able to match the general capability of human beings, right? The next form of AI, and that's not truly available in present, is the general intelligence, which is about actually making an almost human-like experience or human-like intelligence out of machine or technology, right? This is where the machine could actually understand emotions and respond to emotions. Now, you might argue, you've seen chatbots, you've seen Alexa trying to express certain emotional responses. Now, that's not what I'm talking about, right? That's just a clever packaging of weak AI. The general AI would be one where the machines actually understand what emotions are. They understand different contexts. They are able to accommodate different contexts and respond emotionally based on those contexts, besides having a general intelligence expected of any normal human being. By the way, that technology is still not there, right? People are working on it. There are elements of it, but it's still probably a decade away, okay, if not more. And then, of course, there's this sort of utopian goal to develop what's called super intelligence, which is all about transcending the human limitations. This is the kind of AI which, if happens eventually, is what a lot of sci-fi shows and what some people are very scared of, because they think the machines are going to then just take us over. We would be redundant. Okay. Next, let's move to a little more inside of how actually the machine learning works, right? What is the learning part of the machine learning? So let me take an example which will make this fairly simple, right? There's one kind of learning which should be fairly intuitive for us, because that's how all of us learn. Think of it, again, since we are talking of the financial space here, wealth management, asset management, etc. Let's take a case of, let's say you are interested in buying a really hot property, a real estate, right? Either based on where you are in Golf Course Road in Gurgaon, maybe a nice penthouse there. If you are in Delhi, maybe you're trying to buy something on Prithviraj Road, a big bungalow. If you're in Mumbai, maybe somewhere in South Mumbai, a very nice property. Now, how do you go about figuring out what is the right price to pay for it, right? Chances are, if you're a logical person, you would try and get information of past transactions, right? You would look at similar properties, data for the similar properties in terms of their dimensions, their length and their width, how wide they were, whether they were on the main road or inside, in one of the narrower lanes, were they park facing, what's the construction quality, etc., right? And then say for properties which have similar characteristics in the same location, in the more recent times what kind of price uh, is at what the transaction happened, right? And sort of somewhere in your mind you would start to make a mental map, some kind of a graph, right, of these factors versus the price, some kind of a line or a graph or a curve. And then basis what property you are interested in, you try and align it to somewhere in that line to say, look, my property is somewhere between property A and B, and so therefore the right or the fair price to pay is between the two. Correct? Now if you were to ask a machine to do the same, the approach is going to be very similar. Okay, you need to find data set, which is a lot of raw data. This could be data in form of numbers, this could be text, this could be a lot of information on the web, images, etc. This could even be audio or some other data. Clearly some data is more important than other data, right? So for example, if you are looking to find the fair price for a particular property, a particular plot or a bungalow that you want to buy, you would be more interested in the factors which are relevant to it. What would probably not be of equal importance would be the temperature and humidity in that location, right? But that's also data that might be available. And computers, as you know, do not necessarily intelligently differentiate one data from the other. So therefore, from the data that a machine gets or you provide to the machine before it starts learning, you need to extract out, or in some cases, the machine needs to extract out what they call as features, right? Over here, which is essentially the areas of interest, the axis of interest or the factors of interest from within the data, which are relevant to the problem at hand. So in some way, you are telling the machine with the help of an algorithm what relevant features out of the data set to extract and how to start learning. And the learning would be very similar to the process I described earlier, where you would essentially train the machine by giving it specific examples of, look, this property with the following feature set went for this price, right? And once you do that, you do it once, you do it twice, you do it 100 times, 1,000 times, the machine, if it's a smart AI machine, starts to build a model of what would be the best way to predict the price for a property that it has never heard about before, right? That's the very basic form of AI training. Okay, this is called training the model. You give it examples, you give it the inputs, and you give it the desired output to say, for these inputs, following should have been the output. And once you give it enough examples, it is suitably trained, and then you can start to test it by giving it inputs for which it doesn't know the output, right? Because it has been trained well with the previous model, it predicts what the output should be. Of course, if the output is what it should have been, there's a positive feedback that goes back to the model telling it that it has done well, and so it gets reinforced. If the output's not so great, that negative feedback goes in and helps the model improve. This is very similar to how you and I or any human being would learn about a new concept, right? So far, it's fairly straightforward. And this is where it gets messy, right? As I said, with computers, easy is tough and tough is easy. Computers find doing tough jobs very easily, but it finds jobs which we do easily very tough. Let's take a specific example. In the next few slides, we'll go to the heart, to the core of how any complicated piece of problem gets solved using machine learning. So please bear with me. The next few slides, they can get a little heavy, but believe me, by the end of it, you would be glad that we are covering these. Okay, let's take a very simple problem for us as human beings. Looking at a pattern and being able to tell what numeric or what numeral it represents. In this case, all of us know this is a 3, right? Now, have you ever wondered how does this pattern get registered as a 3 in our brain? How do we recognize this as a 3? Of course, all of us have been told that this pattern is called a 3 in sort of Arabic numerals, right? But every time you see this, how does the brain process this information is what I'm interested in, because that's the root of how machine learning would solve this problem as well, right? So Let's go a little deeper into the biology, the physics, and the computer science of it. Okay. When we see this pattern 3, let's hypothetically divide this area into a matrix of 28 by 28 small pixels or boxes. Okay. For every pixel, you would actually have, let's say, a corresponding cell on your retina. So when light reflects on this pattern and hits your retina, the light reflecting from each of these is actually going and falling on a corresponding part of the retina, right? We all know the way we see, right? There's this retina, and as the light passes through cornea, falls on retina, the rods and the cones get activated. The optical signals of the light gets transferred into electrical signals. And then from there, the electrical signals are carried through the optic nerve to the brain. And then something magical happens in the brain, right? That's what we are talking about. That's where this story starts. So think of this as the brain having a layer of neurons. Neurons, as we know, are the basic cells that the entire brain and the neural system works on, right? Think of it as potentially carrying a value of a 0 or a 1. So it's either on or off, right? These are electrical signals, so it gets fired or it doesn't get fired. Those are the two states each of the neurons are in. And this is a 28 by 28 matrix for the purpose of our study. So this is approximately what, 784 or so odd pixels or neurons here. Okay. So the way we see this tree is, for every point on this tree, there is a neuron that's getting fired because there's some light reflecting on our retina and through it, firing a neuron. Correct? For all the points outside this tree, because there's no pattern, no lights actually hitting the retina there corresponding to these points, or actually hitting it with a different color, therefore the neurons are not firing. And so our brain starts to experience an electric signal which feels like 3, right? This is almost braille, the way a visually challenged person would read using braille, using projected surfaces, or surfaces which are not projected. By touching it, they feel the difference and they are able to read. Our brain does exactly the same, except there are electrical signals here, right? So why we are talking of this? Well, we are talking of this because there is a very fantastic built-in mechanism in the brain which takes care of a lot of potential problems in the real world, because the real world is not perfect. So let's look at this, right? What we find is that this pattern of electrical signals would have worked perfectly for this 3, and similarly a unique pattern for a 9, and we could clearly differentiate a 3 from a 9. However, in the real world, we know that a lot of times you don't see this perfect 3. It's more often a 3 of one of these kinds, right? As you can imagine, the neural network, or the neurons that will get fired for this or this or this, will not be this pattern but something else. Some neurons would be missing, there may be some extra neurons, some would be shifted. Now if our brain has been trained to learn from these electrical signals as 3, how is the brain able to adapt and learn all these 3 separately? That's the key question, right? One possible answer to that is that the brain is very resilient. It knows how to ignore errors. So maybe of the 784 neurons that are getting fired, it's able to ignore, let's say, about 20%, and say, as long as 80% of the neurons are firing per my stored pattern, I'm gonna be okay and accept it as a valid input. Yeah, that solves a problem, but then it creates another problem. Let's look at this. Okay, most of you, if I were to poll, would say that this maybe looks a little bit like the 3 here, but it's actually a 9. Yeah. Now the problem is, if the brain were so tolerant as to forgive, let's say, 20% wrongly located or wrongly fired neurons, chances are, if you look at this 9, the erroneous neurons in this pattern of 9 are less than 20%. And therefore, the brain, being a forgiving processor, should identify this 9 also as a 3 rather than a 9. It would get thoroughly confused about whether this is a 9 or a 3, because 80% of the pixels match both, or 80% of the neurons match both, right? Okay. So how do we solve that problem? Well, this is where a concept called abstraction kicks in into our brain and helps us. Our brain is not unidimensional. It is not just looking at a flattish layer of neurons which either fire or not fire, basis which it decides what the number is. Instead, it has several layers of neuron, one behind the other, and it abstracts information out. So, for example, rather than recognizing a 9 from these, let's say 100 or 200 odd neurons getting fired in one go, it identifies this 9 as a combination of a loop on top and a vertical line on the side. It identifies an 8 as a top loop and a bottom loop. It identifies a 4 as two vertical and one horizontal lines of varying sizes and orientation, right? Now, how does that help? Let's revisit the problem we saw a few slides ago again, okay? We saw this pattern 9, and corresponding to this, let's say some 784 odd neurons either got fired or not fired, right? So here are those 784 neurons. For the ones which you see here, the neurons got fired. For the others, they didn't get fired, right? But the brain's not gonna conclude that this is a 9 by now. It's going to break this up into several small elements, okay? And for each of these elements, there are dedicated neurons in a second layer. So what I'm saying is, for the top reddish horizontal line that you see in this loop, let's say this neuron is the one which tells the brain that the loop is present. This neuron is only going to get fired if a number of neurons in the previous layer which were corresponding to this loop over here. So of these 20 neurons here, let's say 18 fired. That's telling the brain, look, most of the neurons are checking the box, hence this horizontal line exists. And so there is a connection from every neuron in this layer to every neuron in this layer. And therefore, if let's say the first 20 neurons here fire, or most of them fire, because there are strong connections between these 20 and this, these 20 cascade into this neuron firing, and the brain recognizing that, look, this is not just a flat layer of 9, there's a top line here, and so on and so forth. I hope you get the idea. There's a next layer which then starts to reprocess this information, abstracts it, and takes a layer up and combines these various elements to make a loop and a line. And at this point, with the presence of the loop and the line getting confirmed, these two neurons getting fired, the final aha moment for the brain comes and it says, this is a 9. And so a final output neuron gets fired, right? This is extremely fascinating how the brain works and how it's been studied, right? The good news here, guys, is this is exactly how we figured out how to train machine and to make it work using deep learning. In deep learning, we mimic layers of neurons, we give it input, we do not actually tell it in the first place as to what the conclusion should be. We let it process and abstract out layer after layer after layer. Every layer of neuron is connected to previous layer. There are varying weights between one layer and the other, and therefore certain connections will get stronger and certain will get weaker based on their correlation. So by the time you get out of this n layer, your data is fairly well abstracted out and a lot of erroneous things have been taken care of, and the computer is able to recognize a face, a voice, is able to think intelligently, solve physics problems, is able to write code, etc., etc. Okay, so I hope this gives you, while it was a little, I know, a little thick, there's a lot of mathematics and calculus behind it which I'm trying to avoid, but I hope you appreciate now that the deep learning that we've implemented as computer scientists is very similar to how our brain, such a powerful organ that we have, works. Okay. Now, having understood the theory, let's quickly go into some examples before we come back to how it is relevant for, the things like fund management and advisory. Okay. Lot of very interesting stuff has happened, especially in the area of credit decision making, in the area of risk management, and in the area of trading and fund management. And we'll see some of these examples. Very quickly looking at credit decisions, this is one of the sort of the, I would say, hot areas and been there for AI, because these were most naturally solvable, where you had to look at a large set of data coming from miscellaneous sources and figure out whether, as a lender to someone, is that person, is that asset safe, are you going to get back your money, or is that person going to default? Okay, so there have been very cool applications, not just outside but actually even in India, where people have been able to make very significant impact using AI to learn and to predict whether a person is going to default. The very interesting part of this, guys, is that they're not even looking necessarily at the credit information, they're not looking at the credit rating of the person. They're looking at things like their spending habits, their credit card statements, their social media, the other people they are connected to, what kind of purchases they are making. Are these more impulsive purchases? Are these more regular, staple kind of purchases? Does the person have a propensity for overspending? And a whole lot of things that you would think are not known. Basis which they predict whether a person is likely to return back the money or not. And the returns are, or the results are there to see. An auto lender that use the Zest Finance system, they cut their losses by 23% just by using the system, right? If you look at the Underwrite.ai's product, again, very cool. A major online lender cut their default rate down from 17.8 to 5.4. And interestingly, Synaptic Systems, where one major credit card company saved more than $151 million in losses in just 3 weeks of using this technology, right? So this isn't the future, this is the present, this is happening as we speak. All of this has happened in the last, I would say, 18 months or so, and it continues to get better. Okay. We'll next talk about very quickly about the sort of the management of risk, another area where AI lends itself beautifully. Certain examples here where you find that Kensho was able to brilliantly predict the demise or the continuous fall of the British pound very close to when the Brexit was happening. And actually, a lot of customers of this were able to make a lot of money by making suitable bets on the currency using this artificial intelligence. They got, not surprisingly, bought up very quickly for more than $500 million in 2018. Okay, and then of course there's ISD, which helps you actually detect money laundering candidates without actually having to invest very significantly in manual research and sort of manpower. They seem to have made significant savings. As you know, anti-money laundering is a big deal for the financial world. Okay, so a lot of it is happening using AI now. Okay, of course, then there's quantitative trading, which is very close to my heart. That's what I've been doing for the last 10 years. Some very interesting examples. The one from Caveout standouts for me because I see a lot of similarities in what they do and what we've done here in India for over the last 10 years. They actually made a stock ranker which consumes phenomenal amount of information, all kinds of fundamental and technical information, from SEC filings to price patterns across markets, across segments, and then they actually rank every stock, okay, in the order of attractiveness, and therefore then use that score or that rank to make a portfolio, with the theory that the better rank the stock, the better it is likely to return or give you returns. The results are fairly impressive, I would say, given that the US markets are so efficient. They've been able to beat the S&P 500 by a very big margin, almost by about 8% annualized over the last 10 years. Now, this is not very surprising to me, frankly, because we've had very similar experience and results in India. Our philosophy is very similar, though completely independent. And we were able to experience similar kind of alpha over a fairly long period in India. So this is clearly a very promising area. And then, of course, there's Alpaca, which forecasts the returns that the short-term returns that a market or an asset class is likely to offer. And this is on global markets that they do. Actually, Bloomberg recently launched them as a service. So they're clearly doing something right. And then, of course, there are numerous hedge funds, and there's AlphaSense that caters to a lot of investment firms, etc. Okay. Other use cases, which I'm not going to spend a lot of time, but they lend themselves naturally very well to AI, would be personalized banking. Clearly, There's a lot of personalization that's possible, a lot of data analysis that can be done using AI, etc. And then, of course, cybersecurity and fraud detection. Another area where you want to check patterns, you want to see any suspicious activities, and you want to continuously monitor data. So rather than someone doing it manually, AI doing it makes a lot of sense. Okay. I'm sure, having seen some of these examples and having seen the video towards the beginning, you would be wondering whether a lot of this is still hype or it's real. So I like to actually consult the Gartner uh, hype cycle. This is a very nice framework they use for almost every technology, where the general theory is, and it seems to work in most cases, is that with every new technology, every new innovation, you see a lot of hype. So there is a lot of innovation to begin with, a lot of talk about it. There's a trigger. The hype keeps going up. The expectations keep going up. They reach a peak, right? And then, of course, at that time, we have talked ourselves into much ahead of what the technology really is. So there are much higher expectations, but not much on the ground. And so from a peak of inflated expectations, we very rapidly go down towards the trough of disillusionment, right? Almost every new technology experiences this, right? And then when people have actually stopped expecting much from it, right, that's when the real work's getting done under less scrutiny and more progress. And therefore the gap between what was expected and what's being delivered starts to reduce. So there's a slope of enlightenment, and finally you reach what is called the plateau of productivity, which is where real applications come to the mainstream. People start to use them and they forget all about the hype as well as the disappointment. If you look back, AI, right, started in 60s and 70s, right? Um, People thought it would change the world, and then for several decades, nothing happened. And then people thought it's dead, right? But you look at what's happened in the last decade or so, I think we are beyond the slope of enlightenment with several applications of AI. What this graph also does very nicely is shows different aspects of AI, different applications of AI, and what stages they are in. What you see here is certain applications which are already there, right? There are others which are probably 2 to 5 years down the line or less than 2 years down the line. And remember, this chart is dated, I think, June or July 2019. So some of these things have come along already a year ahead of what this chart shows. But you also see things like generalized intelligence that I talked about earlier, which are probably still 10 years away, right? Okay. With this, since Kamal had picked the theme of looking into the future, and what lies ahead, I thought I'll take a little snippet of what I think bases a very uh, different perspective on, let's say, what happened in the US and how it is relevant for us as investors, as advisors, as fund managers. Okay. What you see in this, and this is a very busy slide, so let's spend a few minutes here. What you see here is a snapshot of the 10 largest companies listed in US, right? Going decade after decade. Okay, the 10 largest in 99, in 2004, so 5 years further. So from the dot-com bubble of 99, where you had a lot of IT, but more than IT infrastructure type companies that had started to run up. So you saw processor companies, you saw telecom companies, Lucent being a case which was like really bluest of the blue companies. Then it's nowhere now. It almost went bankrupt, right? To 2004, where you saw the momentum going back from hyped up tech companies and infra tech companies to the more sort of traditionally innovative businesses like GE, and then of course the good old energy sector, right? And then some financial, and of course a few technology companies, but more tech, pure tech, rather than more dot-com tech kind of companies at the time. You go further in 2009, that's when, we all know what happened, the global financial crisis. Obviously the financial companies took it on the chin, went away from the list. You saw commodity, energy, some of the other stuff, and then of course a few solid retail and pharma companies start to show up, right? But if you notice the transition from there on, you see something very, very unique here. Okay, there's been a very strong polarization of the difference between the 10, 20 largest and the next. And you also see There's a pattern in the top 10, or most of those at least, right? I'm not sure if you can tell, but if you focus on, let's say, the 10 largest in 2019, and by the way, this is second quarter 19. If you look at today, obviously things have changed a little bit. From a less than $1 trillion, Apple's already challenging 2 trillion, right? So it's become, the bigs become bigger. Okay. Amazon's obviously become very big as well. If you were to look and try and find one pattern in the companies that are now the largest and how it has evolved over the last 20 to 30 years, you find that of the 10 largest that you see here as of second quarter of 2019, I could say 8 of them leverage AI and other associated technologies very big time in their business models. One uses technology, maybe not so much as AI, and maybe the 10th one we could say is not so much about AI as it is about the greatness of one individual, Warren Buffett, right? Now, do you think this is just a coincidence here, that of the 10 largest companies in the world, okay, 8 of them are already powered very meaningfully by AI and other related technology? This is not a coincidence, and this is not a transitory phenomena. This is here to stay, guys. The assertion I'm making here is that the world has changed, and changed very significantly and permanently over the last few decades. From commodities and energy and traditional finance and pharma, the businesses that get rewarded today are the ones which leverage technology, which are not limited by geographies, which are not limited by people, which are not limited by talent pool, which are only limited by how quickly they can spread their technology and find the most suitable opportunities around the world. Okay, whether or not Trump and other leaders want global trades to happen, they cannot stop technology from flowing. Obviously, with COVID, we all know that economy came to a standstill. But look at the business model of some of these companies, right? The tech companies actually had it really good. Some of them actually prospered during COVID. So these are not your good old companies with some cyclicality, with some risk factors. These are 1,000-pound gorillas, but much more robust than maybe economies of big countries, including our own right now, right? And that's how it's likely to be. By the way, a lot of wealth got created in the process. A lot of wealth will get created in the process. One thing is for sure, most of the new wealth that gets created in the next 10 years is going to be around technology and is going to be around AI, because AI is the new technology. Okay, AI is the mother of the new technology. Okay, so if there's one lesson we want to take today from this, what's going to happen in the next 10 years, which is, despite all kinds of very steep valuation that one sees these companies in, there is a reason why they are so expensive. Whether or not you allocate your funds to some of these companies could be a tactical question. Strategically, it's a no-brainer. Okay, the next 10 years, most of the wealth in the world, most of the revenues, most of the earnings, most of the talent pool, most of the capital is going to get attracted by companies in AI and companies in high tech. Okay, let's look closer to our own shore, okay, because this, I think, will resonate with some of you better. Many of us here in this group, in this audience, are either advisors or managers or investors or all of those, right? So let's look at the wealth management value chain as is practiced in India, probably globally. Okay, broadly, you could say there are 4 or 5 aspects of wealth management. Okay, there's a relationship management part of it, which should not be underestimated, because a lot of wealth management is about trust, about trusting your advisor, trusting your relationship manager, and therefore sharing with him your real financial details and requirements, and knowing that he's not going to abuse it, misuse it, and he's going to offer you good, sage advice. So it's about relationship management. It's obviously about product distribution. Thanks to SEBI, the advisory and the product distribution starting to get separated, which is, I think, a good move. Okay, but advisory is at the heart of wealth management, right? Obviously, you could do a lot of other stuff as supporting services, but you need to do advisory, and we'll talk a little bit more about advisory in the next slide. There's execution, of course. Once you've advised, you've distributed, you need to help the client execute. So a lot of us, I shouldn't say us, but a lot of advisors provide advisory services as well. And then, of course, reporting. Once stuff has been advised and executed, you need to be able to report to the investor in a format, at a frequency which is suitable, useful, etc. All of these comprise the wealth management chain. Now, think about it for a moment, the way it has been done in the last 10, 20 years. There are changes, obviously, things have evolved, but have they been disrupted? Have they changed majorly? People still talk about, um, technology-driven robo advisory, but really has it changed the face of the advisory or the wealth management in India yet? My assertion is next few years, it's going to happen. Think about it. Almost every step of the wealth management value chain is already getting disrupted as we speak. Okay, just that we don't know about it yet. Okay, think of relationship management, right? The trust. Obviously, individual persons' presence inspires a different kind of trust, which is very hard to do with technology. Okay, but with the kind of intelligence and personalization that the Alexas and the series of the world are starting to bring, it would be not very far off when you actually see a virtually created relationship manager in flesh and blood talking to you and advising you and giving you the exact same feeling. And by the way, this one doesn't have any vested interest or emotions or selfishness. Okay, so it's pure technology. Think of product distribution. It's already been disrupted. Technology has already started to encourage more and more investors to go direct. They don't have to fill messy forms. They just press a button. More intermediaries are going to go out of the business because of AI, because of blockchain, right? With a blockchain implementation, you obviously don't need much intermediaries. The fees, therefore, in the middle is going to go down, leading to more value for the investor, and they would love it. Why not? Okay. Of course, cryptography is also a key part of blockchain, and therefore of any disintermediation, right? On the execution side, of course, there are all kinds of automated trades, whether high frequency type or the more traditional, let me buy my mutual fund from the comfort of my house without filling a paper form. That's already happened. You don't need necessarily to be offering it in physical means. Sooner or later, that's going to go away. Okay. Reporting, again, we all know it's much more convenient now for someone to be able to access in real time the value of their assets and slice and dice it rather than someone physically sending it once a week, once a month, etc. So if you think of it, of the four out of the five steps in the value chain that the wealth management comprises, each one of them, as we speak, have already been disrupted. Just that in whole, we still feel wealth management still getting more or less practiced the old way, right? Maybe that's got to do with advisory, right? Because that's at the heart of wealth management. Everything else been automated, but has advisory been automated? People talk about robo advisors, but let's see. Okay, as we see here, in my opinion, as an advisor, I need to do the following. I need to be able to do a very good investor risk profiling. I need to be able to align a strategic allocation which helps me map the investor's risk appetite and their goals with what I expect the various asset classes are likely to do over the next 5 to 10 years, and try and mix and match to do a strategic allocation. From there, based on the more short-termish trends of various asset classes and markets, I need to be able to make a tactical allocation to say, look, equity for you 70% over the next 5 years, but right now equity is too expensive. So I'm going to temporarily play out the cash and maybe a little bit of gold game here, right? And finally, portfolio construction, which translates the strategic and the tactical into actual securities, ETFs, PMSs, AIFs, and mutual funds, right? Which ones to select and how. Think of what technology and AI can do here, right? A lot of risk profiling, as we just saw, actually, this is the sweet spot for AI. AI can look at a lot more than asking a few set of standard questions and assessing the risk, the potential risk that the investor can take, right? It can look at the background, the investment habits, the spending habits, and assess a real risk and not based on some questionnaire that the investor has answered, right? Strategic allocation. A lot of case studies and my own personal experience having done this now for the last few years is showing that with increasingly available data and with machine learning, one is able to predict maybe not the short-termish, but the more long-termish return with a very high degree of accuracy. With a little experiment that I've done over the last 2 years, my own models using machine learning have been able to predict the next 5-year annualized return in various asset classes with a confidence of about 86%, with an accuracy of, actually not confidence, but accuracy of 86%, right? Now, again, uh, disclaimer, Indian ecosystem has its own problems. The amount of data available is too sparse and too little. Unlike US, where you have decades and decades, actually centuries of financial history that's available, in India, that's very little. And the model is as smart as much you can train it, right? So therefore, all said and done, these are still early days for Indian finances, right? Of course, the model can do a very nice tactical allocation and finally portfolio construction. You would see a lot of people, whether investors or some advisors, tend to look at the last 3-year, 5-year returns of various assets, of various managers, of various mutual funds, and tend to use that as the primary guidance for what mutual funds and PMSs to allocate to. If you do a little bit of research, you find out that the correlation between the returns of the last 3 years for a particular mutual fund or a PMS in the next 3 years is actually very low. Okay. Usually there are cycles getting played out in the market, and chances are what has done well may not actually do well in the next few years. Despite a lot of us tend to use historical data very simply, right? Compared to this, AI, which is based on cycles, which is based on the learnings, which is based on those weights and fine-tuned neural lessons, which tell it how to look at every single factor, whether it's interest rate, whether it's crude price, whether it's inflation, whether it's GDP growth, whether it's micros, whether it's momentum, to then say what looks like the right sectors and the right asset classes for allocation and which schemes are likely to benefit from it because, hey, this is a value fund or that's a growth fund, etc. That, to my mind, is the holy grail of advisory, which is not too far off, because from personal experience, I can say a lot of this is doable today. A lot of this is being done as we speak, just that no one has probably figured out how to put all the pieces together. So I think we are ripe for a truly amazing wealth management experience using AI sooner or later. Okay. With that, I think I'll just stop here and see how do we want to proceed. Kamal?